Hey Rody, first comment to the broadcast. Hey Michael, hey Britt, thanks for inviting. Hey Grant, hi everyone, hey friends. Thanks for tuning in. Welcome to A Moment in Time with Taylor. Thanks for those of you who are here live. Thanks for those of you who catch this on the replay. We're live on Periscope and YouTube right now. I can't say thank you enough for you guys who make this show possible. Here is everyone who has contributed on the website over the last 30 days. The link's in the profile, nextjuice.com/support. And I'm feeling super grateful, super thankful tonight because I wouldn't be able to do this. I wouldn't have been able to really explore this realm of the world and investing and finance if not for all of your guys' support and, financially, but also verbally, the encouragement, showing up, your presence, being here, your comments, inviting your friends, telling your friends and family. It just means the world to me. So I wanted to start out by just saying thank you so much. Now, I have been studying this now for a little less than a year, so I'm still total newbie, total amateur to this, and I haven't been studying it, every day. It's been somewhat intermittent for the last year. So Michael says, when does school start? I start classes not this Monday, but the Monday after next, and I'm going to school to become I'm going to get my master's in clinical mental health counseling. So I pinned the tweet to the top of my Twitter profile if you'd like to support that journey that I'm going on. We have a goal of $2,610. That's how much I had to pay out of pocket for this upcoming semester because I didn't want to procrastinate getting started, and I had missed the cutoff for all the scholarships, financial aid, everything. So I just paid that out of pocket. Hey, Nelson, first comment over on YouTube. Good to see you too. Happy Saturday to you as well. I've been doing very well. I'm feeling really good. I'm really excited to talk about investing. We started this really probably October of 2018. This live stream is done July 20th. It's 5 minutes past midnight, so technically July 21st, 2019. And I have learned some interesting stuff about investing. I'm lucky to have people in my circle who are active investors and kind of get to pick their brains live and in the flesh. But I also have read at least 2 books specifically about investing. I've read books about the psychology around investing, things about Warren Buffett, the leaders of Berkshire Hathaway. But the most valuable books that I've read were by a father and daughter, actually duo. So one was Phil Town's book, Rule Number 1 Investing. This is one of the most recent books that I read and actually got me back onto this kick of researching different companies and figuring out which ones I'd like to invest in. And his daughter wrote the book I read before this. Her name is Danielle Town, and I read her book called Invested, which was a little bit easier to digest. This one's it's like next level, since this is Next Juice. Michael, thanks for sharing this out. You knew it was Phil, hip clip. Yeah, did you? That's interesting. So in his book, he does talk a little bit about retirements, 401ks. Now, if you're an employee and you have an offer to have your employer match your 401k, you should just do that. It's like free money. You're putting in however much money and they're putting in the same amount of money. So you're doubling your investment right there with really no risk. I mean, all investing is somewhat of a risk, but this is for your retirement. So this is for the future. And the earlier you start investing into your future, into your retirement, the better your chances that you're not going to have to, you're not going to be forced to work until you die and past retirement. So personally, I love what I do. I never want to stop learning. I never want to stop working. I never want to stop creating. But I don't want to feel like I have to because I'm barely getting by, unable to pay my bills, and really struggling. And I think that's the common American dream, or just the general dream for everyone in life and in the world. So that is my intention. I'm 28 years old, so I'm getting in kind of early, but I wish I had done this earlier, and I think a lot of you guys can probably agree with me. Someone the other day was just asking, is 60 too late? Well, it's not too late, but it is, you're cutting it pretty close there. So I'm going to talk about a Roth IRA, which is the kind of, oh, you've had Rule 1 for 20 years, Clip? Nice! Yeah, and Nelson said that's a great book too, so it seems like some of you guys are interested in this stuff and you know about it, which is really cool to connect with like minds. So I know this isn't the most entertaining thing that you could see on a Saturday night, which is why I appreciate even more you guys being here and genuinely being interested in things that are really important, not just getting drunk and dancing to music, these things that can be fun and maybe enrich your life in some way. But I think this is this is the foundation, you know, thinking of the future. I know we're not guaranteed tomorrow. We don't know if we're going to live that long, but if we do we want to be forced to be a Walmart greeter? You know, if we're dealing with arthritis or a dying spouse, aging parents. I mean, there's just so much that goes into being an older person. You know, I'm excited at the prospect of becoming older, but I also want to be very secure. I want to be able to pay for wherever I choose to live and whatever kind of treatments or anything I may need at that point in my life. So I'm going to be getting a Roth IRA. An IRA stands for Individual Retirement Account. A Roth IRA is totally tax protected and it's self-directed. What does that mean? Tax protected means that when you take your money out of the Roth IRA, you don't have to pay taxes. So if you hopefully make money in the future off of this, if you're say you invest $5, right, and it's worth $50, then you want to be able to take that money and not have to pay a big portion of it to tax for capital gains tax, which is what you have to do if you invest in pretty much any other financial instrument. You end up, if you do make money on it, which is the intention, you end up having to pay a lot of it to taxes. Michael, thank you for the first super hearts of the broadcast. Hey there, Gamer V over on YouTube. Thanks for being here. Let me know if you guys have any questions or if you need me to slow down as well. But you get taxed like crazy if you take it out. So Jay, so I don't know that it's really a tax, it's more of a fee. So the rules with the IRA and with the Roth IRA in particular is that you can't take the money out until you're 59 and a half years old and you've had the account for at least 5 years. So when that person asked me, is 60 too late? That's hard because you're 60 years old. So you have to put the money in it now, and then you have to wait 5 years till you can take it out. And 5 years is a pretty short period of time. Like, you might need a little bit more time to allow the market to do what it's going to do to actually increase your money by that point. And if the market goes down or there's a crash between now and the next 5 years, which is very possible, we're not at a crash or recession right now, it's challenging to know how long you might have to wait until you've even made any money and not just lost money and be able to actually take it out. So if you have a lot of excess wealth, I mean, I would say it's worth a shot to at least try to do that if you're looking to get into investing. But there's also a lot of research that goes into what you choose to invest in if you're going to do it the right way or the way that I'm going to be talking about tonight. I'm not a financial advisor. I'm not a money manager. I don't sell any products for you to help you with your money. I just think this is really interesting. This is what I've been learning from my associates, not associates, but like my colleagues, my mentors, my friends, and my books that I've been reading. So I view books as mentors as well. And that is to avoid taxes. So we have the Roth IRA, and also to invest in companies that you would actually want to own. So you don't just necessarily pick, like they have robo-advisors, which are basically robots that look at the numbers of all these different companies and they try to invest, and you pick your level of risk. So do you want to take like brand new startup companies, they just launched their IPO and it's kind of volatile, you don't really know where it's going to be, where it's going to go, high risk, high reward? Or do you want to invest in like these big long-term companies like Microsoft that kind of make billions of dollars every year, regardless of whether or not they're making the smartest business decisions? They're kind of just like this behemoth. Ed calls them a juggernaut in the finance world, and it's more of a safe, low-risk investment. So I have been looking at the Vanguard ETFs for something to invest in with my Roth IRA. Oh, I didn't explain. Self-directed. So tax protected means you don't have to pay taxes as long as you wait until you're 59 and a half or 59 and a half and you've had it for at least 5 years. Then it's completely tax-free. You can take your money anytime that you want. Now, if you take it early, there is fees and potentially taxes that you'll have to pay if you do take it early. So this is, again, for the long term. This is money you're not going to touch, for me, for over 30 years. I'll be able to move it in terms of what it's invested in, and that's what the self-directed part of it means. So I get to choose where that money goes. I'm not just like giving it up to a financial advisor who's going to charge me additional fees, and I get to sell it and buy new things within the account anytime I want, potentially for a fee from your brokerage, or if you use a company that may be a little bit more risky like M1 Financial, Some people say they don't have great customer service. They have issues with them. They're not Better Business Bureau certified. I'm still up in the air on what company I'm going to use. I might just use Vanguard themselves. I don't know. I'm still deciding. But they don't have any fees. But again, that might be a lot more risky because they're a pretty young company and they're not well managed. And then you have something like Vanguard, which is a long-time financial institution that's well managed and charges like, I think $6 or $7 every time you move your money within the account. So for me, that's kind of a lot of money every time I want to move it, but I don't know that I'm going to want to move it a lot. So our strategy here is more of a buy and hold strategy anyway. But when things change with the market, you do want to be able to make some moves and not be paying too much to whoever's moving it for you, your brokerage. A broker is basically the middleman between you and the company you're investing in. And you can't really invest in a company without a brokerage, at least in this level. Vanguard ETF, yeah. Vanguard money markets are great too. Okay, good to know. Jake Kickass. Allison, hi. So an ETF is an exchange traded fund. It's similar to a mutual fund in my opinion, but it's different. It's basically you're buying little pieces of a lot of different companies. So you're getting that diversity. Now, rule number one, investing and invested by his daughter Danielle Town, Phil Town, Warren Buffett, Charlie Munger. It's not really the ideal way to invest. We want to actually find good companies, and we don't want to be like buying 100 companies at once because it's really difficult to track 100 companies unless you want to be a full-time investor and spend most of your time just researching, reading the news, keeping track of leadership changes, keeping a track of insider trading. It's really challenging. So ideally, you only want to own up to like 10 companies at a time. The only reason I'm doing the ETF strategy, what I think I'm going to do is the ETF strategy, is because this is for my retirement. I'm trying to just get in as early as I can and max it out. So the other thing with the Roth IRA is there's a maximum amount of money that you can put in based on how much you earn and what year you're investing it in, as well as whether you're married and how you file your taxes. So I have a boyfriend, but I'm a single person who's filing individually on my own, and I can put in up to $6,000 in the year of 2019. Now that's because I make less than $130,000 a year. If I made more than that, I would be able to only put in less. And if I make more than $230,000 a year, I have no access to a Roth IRA at all whatsoever. So this is also a good way to get tax-protected investments that you may not have access to in the future because you expect your income tax bracket to go up and to be basically disqualified from getting a Roth IRA. It's $6,000. It was $7,000 in 2018. Welcome to 2019, Bob. You still have traditional IRA. Right, you can, yes. But I like Roth IRA for this, for what we're talking about now. How many companies do I own? Right now, I only own Twitter. Twitter's the only one I own. I got it at the end of 2017, and it's doubled since I got it. You joined Morningstar subscription just by QQQ. I would suggest to get a Morningstar account too. That's what a lot of people have been saying. Do I use Robinhood? I have a Robinhood account, but I haven't used it. 415 shares of Microsoft. Nice, Bryce. Okay, I read that. Sorry, I'm just trying to catch up on comments real quick. Hi, Tiki. Hi. I'm just saying hello. Hi, Travis. I got options for January for 40 strikes. Options for January for 40 strikes for Twitter. 40 strikes. Acronis is very good. Okay. A subscription to Barron's. All right, if you guys want to privately message me any of this stuff, because I am trying to kind of like spit out information real quick, and I'm not absorbing everything you guys are saying, and this broadcast is going to be somewhat short, so I'm not like cutting you guys off. I want to talk about this more. I'm just like, I feel like we're going to get kind of off track by getting into this, and I don't know off the top of my head all the differences between a Roth IRA and a traditional IRA, but I know that a Roth IRA has a lot of advantages because they're tax protected and self-directed, and the traditional IRAs are not as much, but they're still probably better than like a 401k if you're not an employee and you don't have someone matching it, because you can't invest in certain things with a 401k, and same thing with other investments as well. But for now, let's just talk about the Vanguard ETFs. So Vanguard is a financial company, and they have a lot of different ETFs that you can buy, and these are funds, and these are basically a collection of shares So when you buy a share of an ETF, if you buy a share of this fund, you're buying a small piece of a lot of different companies, and you can see what those companies are. So based on the ETF that you get, you see what industries and what types of companies you buy. So yesterday, I think it was, we talked about ESG, the ESG ETF they have for US stocks. ESG stands for environmental, social, and governmental considerations that they take. They have to meet certain guidelines. They specifically exclude companies in the adult industry, tobacco, alcohol, weapons, and some other industries that are escaping me at this current moment. They also have to meet certain guidelines or certain requirements for diversity within their organization, as well as requirements, I think, for like basically ethical standards for how they run their actual companies. I think that's pretty cool. I'd like to be socially conscious. I want to own companies that I would actually want to own. Like, consider that you would own all of Microsoft. You probably never will. None of us probably ever will, but that's the mentality we're going at this with. We don't want to own something for 10 minutes that we wouldn't own for 10 years. We really want to take ownership of this. This isn't day trading strategy. This isn't I'm trying to make my money back. Like I just said, I doubled my Twitter investment in less than 2 years. That wasn't really my intention. That's great. I'm happy with that, but I'm not going to cash it out now. My intention, nothing's really changed with the company as far as I can tell, other than they reported good earnings this year and people kind of went crazy. I definitely feel like it's over the price that I would buy it at today. It's more than that right now, so I'm not buying more, but it's still not something that I want to sell right now. It's kind of a young company. I also didn't follow any of the rules from this rule number 1 investing strategy. When I bought Twitter, it was definitely more of a luck of the draw because I love Twitter so much. I have a personal interest in it in terms of like I'm very interested in it. I want to read all about it. I think Twitter's really awesome. I think what it's doing is awesome. I think it has the best live streaming app in the world, and I want to see it do well. So I give it my money because I'm casting my vote and I'm saying, yes, this company, I like it. I want it to do well. I want to own a part of it, and I'm proud to actually do that. Hi, Beth. ETFs are cool like mutual funds. Right, similar. I bought Twitter $18. ETFs you buy and sell them like stocks, but are low risk because they're diversified. Right, and diversification is not actually recommended from these strategies because, like I said, it's really hard to keep track of that many companies. It's much easier to keep track of one company or 10 companies at most. Warren Buffett really says that, like, just for individual investors who aren't doing this full time, you pretty much never want to be invested in more than 10 companies at a time. Now, he also said that you can invest in something, like if you don't know what you're doing, just invest in the market, invest in a mutual fund or an ETF that basically just buys pieces of the biggest companies, the biggest performing companies like Microsoft, we're going to talk about tonight, and just go with that and just kind of ride the market for a long while. Again, not day trading, not short-term gains, not Forex, anything like that. Okay, Bob. We 27% purchase of Next Juice. No, you can't buy Next Juice. Next Juice isn't for sale. I own the whole thing. Roth IRA has silent advantages. Okay. I soak info in like a sponge, Skywalker. That's good. I don't own anything that sounds cool. They report EPS soon. Yes, that's true. They just closed June 30th. Excuse me, talking about Microsoft. Okay. All right. I read some of those. This is like Next Buffet. Oh, Next Buffett, I think he means. Kevin O'Leary just came out with his new ETF. Who's Kevin O'Leary? Sectors of the industry. Right, yeah. So you can. When did you buy it? At 18. I just said at the end of 2017, Bob. Is it liquid? I think it was like August or October of 2017. I can go give you the exact date, but why don't you privately message me, because you seem very like agitated right now, and I'm really just trying to put down some knowledge, and you guys can take what you will and you can disagree with what you will, but let me spit out what I want to say. So I was looking at the different Vanguard ETFs. I thought this ESG one looks pretty cool. I've also looked at a few different ones. So I've narrowed it down to 5 that I thought were interesting. I didn't want to invest in like the industrials or the materials or the energy because I just don't understand those industries and those companies. And I'm a young investor, I'm an amateur investor, I'm a newbie, and I want to invest in my circle of competence. I want to invest in companies that I have the capacity to understand in industries that I have the capacity to understand, at least a little bit. Microsoft's kind of outside of that circle of competence, to be honest with you guys. I understand it somewhat, but I'm not a programmer. I'm not a computer scientist. Pretty much all their whole leadership team there really is and like innately understands these things, so they don't really make it extremely easy to understand when they're talking about it. I don't fully understand like everything that they're doing. I know they're obviously a successful company, but it is a little bit outside of that circle of competence for me. But at least I've heard of it. At least I'm interested in it and learning more about it. And my dad is a programmer, and my boyfriend's into programming, and not into programming, but he's like a computer nerd. He's into this stuff. Sorry to call you a nerd, Ed. Hi, Karen. So it's like, it feels a little bit close. It's a little outside of my range, but it's a lot closer than something like an energy company, nuclear energy, that I like have basically no interest in. I'm not going to sit there and read their whole annual report, listen to their quarterly calls, read their letters to shareholders, and be deeply invested in, like, with my actual energy and attention. I love you, Ed. Thanks for rolling with the punches here. So let me just make sure I have the right webpage chosen here. Yes. So let me show you the different ETFs that I was looking at. Don't mind that right now. We'll get to that in a moment. So this is one, the Vanguard Growth ETF. And if you scroll, so this is just on Vanguard's website. So I know it's cut off a little bit, but if you just search like Vanguard ETFs, you'll find a list of them. And this is investor.vanguard.com/ETF. But you can also just Google Vanguard ETFs and you'll find it. It's in the title of the broadcast. So, I meant to put myself on the screen so you could see me a little bit, but I forgot. So bear with me here, guys. So if you just scroll down, you can see the risk potential. They rate all of their funds between the lowest risk and the lowest chance of really like gaining, and the most risk, therefore you stand to gain the most. And this one is 4. Pretty much all the ones I'm looking at are 4. This is hypothetical growth. Obviously we can't look into the future. And this is what we're really focused on for the next several episodes of this series that I'll be doing. So we have Microsoft, Apple, Amazon, Alphabet, Facebook, Visa, MasterCard, Home Depot, Boeing, Comcast. These are companies that I think have the potential to potentially maybe be within my circle of competence, and I want to research them because these are the top 10 companies that are owned by this ETF. So therefore I want to see what companies am I really buying, what companies am I really investing in here. And that goes for all of these. So this one is the ESG, the one we talked about, environmental, social, and governmental factors. You can see here what that really means. Excludes stocks of companies in adult entertainment, alcohol, tobacco, weapons, fossil fuels, gambling, and nuclear power. Have you tried tarot cards? I have not. I can't say that I have. Fockers in the circle of confidence. What's happening right now? Are we talking about Meet the Fockers? Okay, so again, risk of 4. And the companies are pretty similar. These I think are probably more interesting to me. Home Depot kind of scares me a little bit. I'm not really sure I'm super interested in Home Depot, but you know, I don't know. I'm interested in finance. A lot of these are finance companies. AT&T, that's the company I actually use for my phone service. I run my business off AT&T, so I'm interested in that. A lot of the same companies up here, and again, adding in some more of like kind of bank companies, Bank of America, JP Morgan. So then we have the S&P 500. This is just basically like buying the market. This is investing in the market. It does say on here more appropriate for long-term goals where your money's growth is essential. So this is more like what people will typically invest in when they're retiring, for their retirement funds, and they have no idea what they're doing. This is what they're going to go for. So I'm still going to check it out. Pretty much the same companies. Here you have ExxonMobil, Berkshire Hathaway, but the rest are pretty much the same that we've seen before because of natural disasters. Interesting. Okay. You're a Ferrari among Fiats. Hello, GC. All right, cracker. And then we have the Vanguard Mega Cap. Again, 4 out of 5. And same thing here. Pretty much same companies. And this one, the Large Cap, which is again 4 out of 5. And same companies here. So I know they're putting them at 4 out of 5. Most of these companies are such behemoths that I find it kind of surprising that they consider them to be such risky investments, but we'll see. The beauty, again, like I said, of the Roth IRA is that you can move your money as you want. So if something weird happens with one of these companies, you can move your money away from that company to another company. If you're invested in the ETF, you'd have to choose to either move your money out of the ETF and go somewhere else. But when you're investing in an ETF, you're also trusting the company that manages that ETF, in this case Vanguard, to make those moves for you, basically, to be doing that full time and changing the portfolio of the ETF without you having to go do it manually, which isn't my ideal, but I know I can't do this full time. I'm about to go to school full time, so I'm definitely exploring all my different options here. So what I did is I looked at one of these ETFs. I saw pretty much, I think every single one of these, all 5, starts with Microsoft. Microsoft is the #1 company that they own. So I decided to research them. I did that broadcast yesterday, I think for about like 2 hours, and we looked at the leadership team. We looked at, do they have the moats, the 5 moats? Brand, I don't know if I'm going to remember them all off the top of my head. Brand, Tollbridge moat, price moat, management, not management, I'm sorry. Is management one of them? I think management actually, let me just look it up. I have my little cheat sheet here. You guys want to see it? So we have this, which is just like my little note sheet that I took as I read through these books. Rockstar Games, the casino opens July 23rd. Trust and stick with ETFs, back out if needed, but they're meant for the long term. Right. So what are we looking at? We're looking up here. So first, the meaning, we talked about that, your circle of competence. And maybe I should actually write that just to remember that term. Okay, moats. So here are the moats. Brand moat, switching and network effects, Tollbridge, secrets, and price. So I also made I don't know if I want to show this or not. Let me pull it up first. I made a little, oops, that's not what I want. I made a Google Doc just about Microsoft, so I could write notes as I learned about it. What I wrote here is that it has the brand, switching and network effects, secrets, and price moats, but it doesn't really have a Tollbridge moat per se. I mean, I guess it does on some of their products. It probably has all the moats, okay? It's a very powerful company. It's a castle. It has powerful moats around it. They're aware of competition. They're trying to protect themselves from the outside, from the inside. You know, it's not their first rodeo. So they have pretty much all the moats. They have, yeah, I'm not going to probably show that page there. Then you want to see how their management is, and that takes a long time. That took me a few hours to actually go through their whole board of directors, their whole leadership team, all the executives, look into them, see what they're about, try to get a feel for them. Not really a whole lot of scandal going on here. I did not love how many of them worked for the McKinsey management company, the consulting firm. I'm not a big fan of McKinsey myself, and McKinsey definitely has been involved in a lot of scandals, so little bit of like a little taste in my mouth. Politically, I don't want to get into politics right now because this broadcast it's just outside of the scope of this broadcast. But personally, so again, I'm looking at whether I want to own this company or not whether the numbers and figures make sense. I'm not a robo-advisor. I'm not a financial advisor at all, but I'm not a robot, and I'm not just looking at the numbers. I look at the company first, then I get into the numbers. I don't want to be wooed by the numbers first. First, I want to do my due diligence and my research. And then if I don't completely hate the company, then I can go through with getting all the numbers, which takes a while. I got the numbers from 2018 back to 2003. So it took me quite a few hours. Robo-day. So what you're looking for in the management team, you want them to be humble, owner-oriented, and reasonably paid. I actually didn't get into the pay structures of the management team just yet. I actually just realized I didn't do that, and I'm not going to do that right now during this broadcast either, but I will get to that before I go buying anything, which I probably won't for a little while anyway, because this is just one company out of at least 10 that I want to research. My ideal situation is that I find one of these companies that I really love, and it just happens to be at a crazy sale price, and I find it to be a good margin of safety price, and I just buy that company and put my retirement into that, which I know is some people consider to be more risky, but like Warren Buffett, or actually it was Andrew Carnegie. I think Andrew Carnegie actually said, you know, put all your eggs in one basket, but then watch that basket closely. So just saying, these are my personal ideals. So politically, I feel like a lot of the leadership team is not exactly in alignment with myself, but I also, again, like I was talking about in my last broadcast, I don't think I'm thinking big enough for Microsoft. Microsoft they have to do a lot of lobbying. They have to kind of go with like whoever's in power at the time. They have to, they have a PR, you know, they have like a public opinion, a public image that they have to maintain. So I don't know these people on a personal level. I don't know how much we agree or disagree, but some of them were they were just like very steeped in politics, and politicians running a company is not my ideal either. I kind of want them to be, they can have their own opinions, but I don't necessarily want to see them like posting on Twitter about it a lot and kind of like getting into, you know, like fighting against or with the president against, you know, it's kind of like not really the role I want to see them playing, not really what I want them to be focused on. I want them to be focused on the company and the owners of the company, which may be myself if I choose to invest in it. I don't really want them to be focused on like political drama and scandals in the public eye. Everyone has the right to do that, right? We're in America, free country, freedom of speech, totally cool. There wasn't a ton of that going on, especially not in the actual leadership team, but some of the board members were, a lot of the board members were from McKinsey, and a lot of them were very like politically charged on their social media, and that to me rubbed me a little bit the wrong way. So I didn't love that. I'll just put that out. Blueberry guy, that's pretty much an anonymous person. E is for empathy, E is not for elimination. Okay. Random. I put that the financial reports on their website weren't very user-friendly. It was kind of weird to me when I was searching. It was easier for me to look up the reports that I needed to get my numbers for Microsoft from the SEC than it was from their actual website. And it's Microsoft. Like, I feel like their website should be out of this world, and it just isn't. Apple's website, I just peeked at Apple just for a moment, and Apple's website was like way more user-friendly. But even still, I found Twitter's to be the best. I think it has the best user interface, the best user experience. Maybe I'm an amateur investor, but it was really easy to, I mean, it's just like, everything was just very easy to use. It was almost like it's catered towards a younger audience. Microsoft was very outdated, right? So this company's been around since, what, the 70s? 80s? I think 70s. So it's just like, well, yeah, I mean, I think it's 1975. Not everything is going to change with the times very quickly. When you're a huge company, it's not that easy to pivot and move and be very agile. You're kind of like, you're just huge. You're sprawled out. It's hard to like turn in any other directions. The last thing they're probably worried about is like how vague and ambiguous their mission statement is. But I'm sitting there as a potential investor going like, like what do they even do? It's like, we help people reach their full potential. Like, we help companies do things. We want them to do more things. That's what it said. Like, we want them to do more. We want to help people do more. And I'm just like, what the hell does that mean? Like, if I was looking at a small company, if I was like an angel investor, I had all this money, and if some small company said that to me, I'd be like, no. Like, what do you actually do? Like, what is your actual mission? What do you see this company representing and being in the future? Like, where are you, what is your trajectory? So I didn't see that in their mission statements and their annual reports, and I was kind of like, hi Wayne, can I get a what? Hi, how are you? So I was like, I don't know, didn't love it, but again, I'm young and I'm trying to be open-minded, so I just kind of went with it. I put weak and vague mission statement. Unimpressed with the intro information in their 2018 10K report. It's like they were following a script. Well, it's like written out. It's like in there, but I think it's probably just been there, and they just don't really edit that part. Like, they edit all the financial information and whatever happened that year and their trajectories, what do they think is going to happen, like if they're anticipating good things, bad things, but they don't necessarily go and like change like the intro part of their annual report, and probably haven't done so in a while. And to me, I was just like, this just needs to be changed. Like, it's so not, it doesn't make me go, yeah, this company is awesome, I really want to buy it. I'm reading it and I'm like, but what do you do? This is what I do with a lot of live streamers. Like, they're like, you know, I'm like, but what do you do? Like, what is your actual business? Like, what is your service? What is your product? What do you do? So anyway, they have over 53,000 U.S. and international patents issued and over 29,000 pending. So they definitely have that strong secrets moat. They employ 131,000 people on a full-time basis, 78,000 in the U.S., 53,000 internationally. Thank you, Nonstop. These are just my notes I took on Microsoft from researching last night, so I'm just kind of getting you guys up to speed. I know I'm talking a little fast. It's 12:30 in the morning, and I'm just trying to like bang this out real quick. So if you have any questions, feedback, concerns, criticisms, feel free to reach out to me. I respond to all my private messages on Mondays. So you can DM me on Instagram, Twitter, or email me nextjuice@gmail.com. I'm Taylor. Hi. All right. I'm not convinced that the purchase of LinkedIn or Minecraft were intelligent investments. I do like Skype though, and that Xbox is not competing well in the gaming industry. Now again, this is my personal view. I don't use LinkedIn. I'm not a business to business person, right? I'm business to consumer. So LinkedIn isn't really like the place where I do my networking. I could maybe, it's just live streaming, the live streaming industry is still pretty young. There's just not a lot of like big live streamers, and LinkedIn is just not really our community. That's not really like where we hang out, right? We're more on like the more social, I know LinkedIn is technically social media, but we're probably going to be more likely to connect and collaborate through Instagram, through Twitter. Maybe it's generational, but LinkedIn, I'm kind of like, meh. Ed, on the other hand, is telling me, oh, LinkedIn is so awesome, it has so much potential, they're doing all this stuff, it's like making all this money, they have all this ads, it's like the way of the future for networking for businesses, and I'm like, okay, so different points of view. Minecraft. I personally don't really understand Minecraft. I don't understand why people want to play like an 8-bit pixel game. The creative mode is pretty cool, but it's not, I'm not artistic, I create in different ways, right? I'm more black and white, I'm more concrete, I'm more of a like thinker than a builder. So I just don't really get into it. My stepsons love it, my boyfriend loves it, they play it all the time, they build cities, they get super creative, and I love to see them do it. It's really, really cool. At the same time, like, these graphics are like painful, they're just, ugh. But it's their gaming sector, Microsoft's gaming sector was really, really struggling. So they bought Minecraft. They saw like over $100 million increase the first quarter after buying it, I believe. So it seemed to be pretty smart. At the same time, I'm just like, but why? Like, why is Microsoft trying to even be in the gaming industry and make money off of that? I don't know. Again, maybe I'm really trying to be open-minded, but these were just my instincts, just my own thing. Hey there, Rec, how you doing? So I also put that they have 24 million square feet of property, real estate owned, 26 million square feet leased, 31 buildings in the US, 19 internationally. This I thought was interesting. I did write the word BS. I wrote it out in all caps. The Tax Cuts and Jobs Act, which was signed into law in December 2017, it caused a $13.7 billion charge to Microsoft due to being taxed on foreign income that was previously untaxable by the US. It was a one-time transition fee, although their year ends June 30th in 2018, so the rest of the fee will show up in the 2019 report in the next couple of months. Yeah, you got it, Juicy. And then the bright side is that the tax level was lowered from 35% to 21%, so the one-time fee was just intense. But I also don't know if that means like all their foreign income before wasn't being taxed at all, and now it's all being taxed at 21%. So even though their like U.S. income dropped down from 35% to 21%, that seems good, but I'm a little confused as to how the foreign income really works in that grand scheme. So we'll just kind of keep an eye on it over the next year or two and see how that pans out. Jojo, we're talking about Roth IRA. And if you're an employee who has an employer that's going to match the money you put in your 401k, you should do that. I wrote Windows Phone was a complete bust, and then I wrote this company needs to choose what they want to focus on and focus on it. They're trying to get into every industry, and the cost of this level of experimentation is damaging their bottom line, which is true, but I did concede in my last broadcast that maybe I'm not thinking big enough. They're still making billions of dollars no matter what they do, and even myself, I say, Abe, always be experimenting, ABE, like we should always be experimenting. So they can just experiment on this huge level that to me I'm like, oh my god, you're wasting billions of dollars. But they're like, well, we're still making billions of dollars, like netting billions of dollars. They're still bringing in pretty good earnings per share for their shareholders. You're like, okay, like it's hard to really argue against that, you know? Abe Lincoln, you have a Roth IRA? When you worked for GMC, they matched at 25%. Whoa, nice. Don't research companies, then make informed decisions. Just get a magic 8 ball. It's way faster. Invest in Roger. I have a Roth 401k. Oh, I didn't even know that was a thing, to be honest. With my current employee and a couple thousand in my ex-employer, should I roll? I don't know. I'm not a financial advisor. I've only been studying investing for less than a year, and I actually don't really know much about that. What I've been studying is investing in particular companies and stocks, not actually like all the different retirement vehicles that you can use. The Roth IRA comes recommended by Phil Town, whose book I just recently finished, because it's tax protected and self-directed. So I can move my money around in that fund freely, and I don't have to pay taxes as long as I wait till I'm 59 and a half when I cash it out, and I've had it for 5 years. So just to be honest with you, I'm not the right person to ask that. There might be someone in the chat who has an opinion on that, but hopefully some research can help you. Or if you message me, I can try to look into it and see what I learn if I research it too. Commodities such as natural resources. Invest in what has meaning to you. Invest in your circle of competence, something that you have the capacity to understand and something that you're actually interested in, because you have to keep track of this company's management team. You have to keep track of any changes that happen to them or their industry, and you have to be able to read their annual report every year, and you have to be able to listen to their quarterly calls every quarter, and you have to be able to read their letters to shareholders. You just have to be interested in it. So if you're interested in it, then it's something that you could potentially invest in if the price is right. So those were all my notes on Microsoft from my research. I do realize now that I forgot to study to pull how much the management team actually makes. So I'm gonna just make myself a note. Pull management income numbers, and I'll do that. I'm not gonna do that live with you guys. I'll do that on my own, so you're not sitting here drooling while I stare at my computer for a long time. I always see, invest in gold, but doesn't seem like a wise decision. It's like an alternative to the dollar, right? So it's not something that you're really trying to make money on. It's something that you're trying to preserve your money with. People think the dollar is going to crash, so they're like, well, because it's a fiat currency, it's not backed by gold. It used to be backed by gold. Gold is something that they believe, and I even believe this too, like gold is like real currency. Paper isn't real currency with nothing to back it up. So for me, I'd actually rather have a company, because I feel like a company is actually something that's going to like hold its value, and it actually provides a value or service, where having a bunch of dollars is like, really, what do they really do? If the government was to say like, oh, this is every year we lose about 3% of our money to inflation. So putting it somewhere, I think, is better than just leaving it. But you might be in debt. So the first thing you have to do is get out of debt. Or you might, you got to pay off your credit cards, get out of debt. And you might have a spending problem. Like, okay, you don't have any debt, but your bank account's like always like just enough to pay the bills. Like, we're like buying everything on sale at the grocery store because, we got it a little close. So you have to go from getting out of debt to not spending all of your money and figuring out a way to actually save and accrue money. And then you'll get to that. You'll know when you're at that point where you're like, I have dollars. I have lots of dollars. Now, what do I do with these dollars? And then you'll learn more about it and figure out what makes the most sense to you. My ex, really, really, really big into gold. He thinks gold, silver, precious metals is like the best investment you can make. Through my study and research, I'm more interested in companies. I'm more interested in businesses. I think that that's really like the free market. It's capitalism. It's what I like. He likes that stuff too, but he's not really interested in business like I am. He's more interested in gold and like oil and commodities like you're talking about. I'm not. So it's just more of like a personal preference, I think, more than necessarily one being right or wrong, unless the dollar would completely like no longer existed, like they were just like, screw this. But it's still the currency of the world, it's like the world reserve currency or something. So it's, I don't know, your choice. 77 cents per share currently every quarter. What do you mean, dividends, or you mean earnings per share? All right, good night, Carrie. Debt snowball. Yep, so the debt avalanche or the debt snowball. I think the debt avalanche makes more sense than the debt snowball. It's more logical, but it might not give you enough dopamine to really keep with it. So totally your choice. But the debt avalanche is going to get you out of debt sooner, and you're going to pay less money towards interest. We're talking about, if you guys don't know what that is, that's the Dave Ramsey's techniques for getting out of debt. Debt avalanche means you pay off whatever has the highest interest rates first, Debt snowball means you pay off the lowest loans first. So if you have like $500 on one credit card and $2,000 on another one, well, even if $2,000 has higher interest rate, you pay the $500 one off first because you're going to pay it off quicker. And once you pay it off, you're like, okay, good, I got that done. And it keeps you going. It's like, you know, okay, I paid one off. You get that feeling, that dopamine release, like I did it, now I can keep going. So it makes more sense to pay down the one that has higher interest first, because then you're paying less towards interest, you're paying less overall, but it takes longer if that's a higher number. So it just kind of depends on how many you have, and if you're kind of like overwhelmed with having so many different credit cards and loans to pay all the time, you're having trouble keeping track of it all, and you want to get rid of some of them and make it more manageable, then you might do the debt snowball first and then switch. Everyone's probably going to switch to the debt avalanche at some point. It doesn't really make sense to focus on like paying off your student loans and car and house before your credit cards, really, to anybody, you know, but your car and your student loans and your house probably are larger numbers than your credit cards anyway, so it kind of works out that you're going to pay those first regardless. Make sense? I hope so. It does make sense, but do you understand? Shopify, PayPal, either at the moment. Yeah, PayPal is actually on my list to research. Shopify I don't know much about. Should I add it to my list? I will. I trust you. Investing watch list. So I have an investing wish list, watch list that I put different companies. Like I just started going to Planet Fitness. I've gone there now every day for 22 days in a row, and I have them on my list now. I'm like, Planet Fitness? I don't even know if that's publicly traded, but I assume it is. And I'm like, I kind of like Planet Fitness. We'll have to research it. All right, so what did you say? Shopify. Check it out. And who is that said that? Oh my god, Anthony Minetti! It has been so long! How are you? How's mama? How's everything? Thank you for all those super hearts. So good to see you. Highway Star. Highway Star on Perry. Alright, cool. I have noted that. I put my money in Beanie Babies. So many people say Beanie Babies. You guys are funny. Roth IRA for 50 years can turn 20K into a tax-free nest egg. You got it, Jordan. You just nailed it. That's exactly right. Financial Peace University was really helpful for me personally, right? That's the Dave Ramsey program, you guys. If you're in debt, totally recommend that. I've never read it or used it, but I've never also really been in debt, so I've heard really good things about it, though. I missed SiriusXM at 18 cents a share a decade ago. See where it's at now. I don't know where it is at now. All this money talk's making me hungry. Go eat something. Oh my god, Anthony, look at you go! Thank you so much. I was just saying we're like just under 1 million super hearts away from getting the 3 million bonus this month, and we have not been hitting that. We're just not making as much money this year as we made last year by like half. We're making like maybe half of what we made last year. So I'm like, come on, 3 million super hearts this month. Come on, come on. You're totally helping get us there. Cash Cannon. We could do Cash Cannon if you want. It's up to Anthony. Planet Fitness has caught my eye since it's only $10 a month. Yeah. Well, I mean, not the shares. Like, okay, now you guys got me wanting to look up Planet Fitness stock. Planet, PLNT. It's $74 a share. Wow! That's like more than I would have expected for some reason. It's way up right now. Yeah, that's another one that I probably should have bought like a long time ago. But I didn't know anything about this stuff, so. But it's more than tripled. It's almost, it quadrupled. It was at like quadruple of its price in 2017, even like halfway through 2017. It quadrupled in June of this year from that point, so that would have been a nice one. But here we are. We're here today. We'll add it to the list. We'll research it. We'll come up with a good price, and we'll buy it when it hits the price we want it at. Prosper is good. You, among others, lend money to others who either have real good credit or bad. Oh, that's a cool idea. So, okay, Cash Cannon. Always take a look at stocks trading below $1. They have 1 year to get over $1. I'm not really interested in penny stocks personally. Unfortunately, in the hospital. Oh, Anthony. Oh my goodness. I'm so sorry. She's so blessed to have you there and to be seeing her so much, but I'm so sorry that you're dealing with that and her and your whole family. Does she get to see the babies? Do the babies get to go see her? I don't know if you want a baby in a hospital or not, but I'm just wondering. Hey, generic dude. Yeah, running the midnight oil. I purchased 100 shares of Shopify 2 years ago at 55. It's now at around 331. Nice. BMY. What's that? Going to see her again tomorrow. Saw you online. Had to come and say hi. Oh, yeah. No, I love you, Anthony. I get it. I know you can't always stay for long. You're a super busy guy. But I know that, like, things will settle down and we will be able to reconnect on a deeper level again, just like we used to. So I'm here. I'm not going anywhere, like I always say. Update, I am going to be starting classes. I'm starting classes a week from Monday. I set up a GoFundMe and everything because I didn't want to procrastinate signing up for classes, so I missed like scholarship deadline, financial aid deadline, because I just like made the decision, you know, I'm not going to put this off anymore. I'm going to enroll in classes. I'm going to enroll in the summer. I'm not going to wait for anything. So I had to pay like $2,600 out of pocket. So I put a GoFundMe for the exact amount that I spent, but I am going to look for like grants and scholarships and stuff in the future. But I'm getting my associates in psychology, then bachelor's in psychology, and then I can get my master's in clinical mental health counseling, which I really think is just like my calling and what I've always really wanted to do. And it's going to be a lot of work, but all my content is going to become like studying and researching things about psychology and whatever random classes they make me take in my associate's degree. It's going to be crazy. So I'm trying to get all this investing research and all of this done as much as possible this week, because it's going to switch to a totally different type of content the week after that. Thank you, Anthony. Yeah, of course I understand. I mean, I don't understand, right, because I haven't been in that situation, but like I'm trying, like, you know, I'm here for you anytime you want me or need me. Just text me, you know, I don't have to be live. They aren't penny stocks, they're underperforming NYSE stocks. Sirius XM was in that category. But if it's under $1, isn't it technically a penny stock? Bristol Myers. I don't know, what is Bristol Myers? Look up shop. I will. Not right now. I put it on my list, though. I love you, Anthony. It's always so good to see you. Fundrise is good, too. Similar to Prosper. This site, your money is invested in various real estate. Cool. Yeah. CCMHC would be when I get my board certification, board certified clinical mental health counselor. But that is many years away. So for now, I'm just Taylor, the yoga teacher who likes to study investing, go live, help other streamers, and spread positivity. Talk about Microsoft. All right, let's look at the numbers. It's time. You've made it. If you've made it this far, congratulations. Here's the fun stuff. So I pulled these numbers last night. I made these. I made the spreadsheet based off of the books that I've read. Invested in Rule Number 1. I've been talking too much, and now I need more water because I am drying up. Crap, I wanted this broadcast to be like 30 minutes long, and it's been 53 minutes, so let's power through. So I pulled all these numbers. Let's, oh, this isn't the top. Let's go to the top. Okay, so we have net profit, total revenue, equity, operating cash, equity plus debt, return on the equity, return on invested capital, depreciation, amortization, accounts receivable, accounts payable, income tax, maintenance and capital expenditures, owner earnings, the 10 cap price, the number of shares. So this is basically what all these numbers, when I run them together through my spreadsheet, this is basically what I think the company is worth today. $480 billion if you were going to buy the whole company. So you divide that by the number of shares, and that gives you your 10 cap price per share, which is $86. So $86 would be a nice price to get for Microsoft today to get a solid return on your investment in the next 10 years. Again, we're looking to invest for over 30 years for the retirement purposes, so this is not something that really, you know, we don't really need to make the money back in 10 years, but that's an interesting number. And it's currently, when I looked at it last night, it was, well, it's Saturday anyway, so it's still $136 per share. So it's a little overpriced. Not something we really want to buy today. The earnings per share it brought in 2018 was just about $3 per share. Again, it had that almost $14 billion one-time fee because of the Tax Cuts and Jobs Act that went into effect December 2017. So that was unexpected, kind of, well, I don't know if it was expected or unexpected, but it would have been a lot more than that if not for that big fee. Yay, Anthony! That makes me so happy! Well, I'm glad that you missed it, because some people are probably like, it's Saturday night, what are you doing right now? Thank you later. Okay, I will thank you later because I'm not going to get to that by the end of August. I have so many more to research before that. I don't know. I don't know Highway Star, but I am going to look at both companies. So hopefully it won't really matter. But I'm, like I said, I don't really want to buy Microsoft right now because the price isn't the right price. However, if I'm going to take my retirement seriously, I can't always wait for the price to be right to invest because I'm investing for 30 years, so it's not something that really needs to pay me in the next 10 years. So we'll just see. We'll see. You also cover PDE. So PDE, in terms of what we're doing for the pricing, so the first, there's 3 forms of pricing that we do from the books that I've read. I'm not a financial advisor. This is just, I read it in a book, and now I do it. I wish that you could guys see my face still. Sorry guys, I messed that up with the layout, but anyway. So 10 cap price per share is $86. The 2 other forms of pricing we're going to do is payback time price and margin of safety price. You can see that on the bottom. Now, I need a few more numbers in order to get these results. So I need an estimated growth rate. So I evaluate my estimated growth rate. This is an estimate. This is a this is a percentage that I pick. Me, Taylor, I pick this. You might estimate the growth rate to be different. This is what percent do I think this company is going to grow each year, and on average, right? Like what do I think? So the way we do this is we look at the previous numbers. So here are the big 5 numbers. 1, 2, 3, 4, 5. Oh, excuse me. And we decide, now I didn't run these other numbers here all the way to the end because those numbers really only matter for my 10 cap price, and I don't really care what the 10 cap price was in 2014 or 20, because I put them in the last few years. Really all that matters to me is what do I want the price to be today. But these numbers were really easy to get because they usually give you the last 4 years at once. So I just put them in so we can kind of see a progression there. You can put all the numbers in if you want, but it's not really necessary because what difference does it make what it was worth back then to buy, considering that we can't buy it in the past, right? So not really too concerned about that. Now, what was I going to say? Oh, so we look up here and we try to see historically what is their how have their numbers been growing now, or decreasing, or not growing, right? Thank you, Anthony, for inviting your followers. That's true, Highway Star. So they're all over the map, right? So this year they're down 35% in their net profit. Last year they were up 24% in their net profit. Year before that they were up 68% in their net profit. Year before that they were down 45%. Before that they went up not even 1%. Before that up 28%. Before that down 26%. So you're like, oh my god, what the hell do I do with this? So there is kind of a hack, not really a hack, but there's an order of importance for these, for the 4 growth rates, the big 4 numbers. And this is again all Phil Town knowledge. I don't have any cannabis. I literally don't have any stocks but Twitter. So the most important one is the equity. So let's go check out the equity. Where are we going here? Let me close that one. So equity here is the most important number. So even though all these numbers, some of them are really big and they're kind of volatile, well, down here it's more steady. So you have down 5%, up 5%, up 4%, down 10%, up 13%, up 19%, up 16%, up 23%. So we want to look at the last 10 years, so really it's like 9 years of data. So if we go back to 2008, we're really looking at these numbers, 1, 2, 3, 4, 5, 6, 7, 8, 9. Actually, wait, am I saying that right? 2009. Wait, 1, 2, 3, 4, 5, 6, 7, 8, 9. We're really only looking at these 9 numbers, the growth rates, but you do have to pull numbers 10 years back to get those numbers. But again, this is a Phil Town thing. So in his daughter's book, she said 10 years. In his, he said 9 years. He's a lot more experienced at this, so I'm going to go with what he said. So I want to start looking at these numbers here and average those out, which I could do in my actual spreadsheet. But I don't know if I want to go in there and make that whole cell right now. I think I'm just going to do it manually with my calculator just to kind of get this over with. I don't know if I'm going to do this all live, you guys. I wanted to, but at the same time, I'm like, I really need to go to bed soon. So I think I'm going to do this on my own. So what we're going to do is we're going to average those out. We're going to find an average. And then we're also going to just take our own personal guess, right, based on kind of like what they're doing. When we studied, we learned about Azure, we learned about the AI, we saw that they bought Minecraft, we saw they bought LinkedIn, we know that they own Skype. What do we think that means for their future? And we're going to make an estimated growth rate. We're going to take that number, we're going to plug it in here. Then we're going to make our payback time price. We just plug in these numbers. This is the free cash flow times the estimated growth rate. So the free cash flow, do I have that already? Free cash flow is $32.2 billion. And I'm just going to take that number. I don't know, can I copy just the value? Let's see. Yeah. And we're going to add in the estimated growth rate. So let's say it was 10%. We're going to take this number, so B2 times 1.1. Okay, we're going to add 10% to it. And then we would just basically copy that down. And this would be equals B2 plus C2. I believe that's what I'm looking at here. Oh, sum. Hang on, sorry, I forgot sum. Sum? Is that what I want? Does this seem right? Sorry, I gotta go pull up my Twitter one. Let me turn this off for a second. Hi guys, haven't seen you in a while. I just want to make sure I'm doing my math right because it's kind of late and I'm like taking from someone who now works 12-hour days. If you need sleep, go get it. Yeah, I need to wind down too because I can't sleep right after this. I'll probably work on this, not live, but I'll be like hanging out, kind of chilling in front of the TV rather than being live and like feeling like I have to be on. So Twitter, my estimated growth rate for Twitter was 10%, so that's why I use that example here. I'll share that with you guys here. So that was their free cash flow in 2017, and then my estimated growth rate was 10%, but then we actually got the numbers from 2018, and the growth rate was actually 27.64%. So my estimated growth rate turned out to be quite conservative, which is nice, and I can always kind of change my estimated rate as we go, but I kept it at 10% for now because I'm a newbie and I want to keep it. I want to keep it low. So my estimated growth rate is 10%. So yes, yeah. So this is, oh, I actually just typed in 10%. That's weird. Is that what I have over here? 10%, 10%, 10%. Let me just copy this down. And then, so I wouldn't, yeah, so this ends up being not B2 plus C2, I'm sorry, this ends up being B2 plus D2. Yeah, that looks right, but let's just double check it over here. B2 times? Why am I timesing it? Oh, times by that. Oh, here, yes, B3 plus D3, sorry guys, again, getting kind of late. B3 plus B4, did I take those out? Get rid of this. Has growth potential, of course, yes. So copy this down. That gives me my free cash flow. Number of shares we already have. So number of shares is this number, 5.6 billion. We'll put that in. That's going to remain the same, but you want to check it every year because sometimes, like what happened with me with Twitter, is that they, oh, I didn't change it, did I? Did I not put it before? That's weird. Why is there no number here? I don't really remember why I changed this, but they actually watered it down on us. So did I change it in my 10 cap? You can see the change in number of shares. It went up, and you know, I didn't actually change that over there, so there you go, look at me, messing it up. So, Control Shift B. Shouldn't that change this? E3 divided by F3? Maybe it was just, it was only, I think it was like 6 million, I guess it just didn't change these numbers. So you want to check that because they might water down. So you end up owning less of the company when they release more shares, when their total number of shares goes up. So anyway, there. See, I just fixed my Twitter now too. So that would mean that today you would want to buy it for $6. Okay, we'll see you later, Anthony. Have a good day. If you wanted to, what am I saying right now? Guys, I think I might just need to like end this and think this all through before I go live. Figure it all out and then just tell you when we go live. Oh yeah, no, so down here, this is the price. So if you wanted to make money this year, like if you're like, okay, I'm going to just cash out in a year, you would buy it at, this is Twitter, but you would buy Microsoft at $6. If you want to make money in 10 years, then you're looking at like $78 would be a reasonable price. So you compare that to your 10 cap. So this is 86, this is 78, so you have kind of a range. You're like, okay, you can kind of look at your high range and say, all right, well, if it gets to 86, I'll still buy it. But, you know, it would be even better if it was 78. And that's only if you only expect it to go up 10%, you know. Hopefully we want it to go up more than that, but you just never really know. And then same thing here, estimated growth rate. Your estimated P to E ratio is going to be the lower of either 2 times your estimated growth rate or the highest P to E ratio that they've had over, or the lowest. Wait. No, not that. This. I take notes for this very reason because I can't remember all this either. It's the... Oh yeah, this was different. This was different in the book I read recently. So Invested said the lower of the, I think the lowest P to E ratio in the last 10 years, but he actually wrote, Phil Town, her father, in rule number 1 wrote the average historical P to E in the last 10 years. So whichever one is less. 2 times your estimated growth rate, which for Twitter for me was 10%. So I estimated, I put that as 20 because their P to E was never lower than 20. So my estimated P to E, I don't really, oh, it was 20 down here because I was just trying to calculate the price again for 10. I could do this for this whole row if you want, which is basically what I did with the 10 cap price. It might be easier the way I had this one though, where you're just looking at the price on the bottom rather than these. So this would be my half off price if I could get Twitter for $11. Or with Microsoft, I don't have my numbers to plug into Microsoft right now, so we'll figure that out. Sorry, I was hoping to have that done on this broadcast, but as you can see, we're already going way over time. I always underestimate how long it's going to take me to get this stuff done and how much we're going to get off track and how much I can just talk. So thanks for watching. I will finish this up and go live with you guys on this probably in about 2 days because tomorrow we'll be at the beach. I go live on Periscope every single day, 7 days a week, so feel free to check that out. If you're watching on YouTube, you can follow me. It's the same username over there, NextJuice, N-E-X Juice, J-U-I-C-E. And you can also click the link in the profile, nextjuice.com/support, and help us to keep this channel going and growing together. If you check us out on Twitter, you'll see that posted or that pinned tweet at the top of my Twitter page, which will show you how you can support my education to become a clinical mental health counselor. And a huge thank you goes to all of you who sat through this crazy math on a Saturday night and talking about investing, and everyone who makes this show possible. I can't say it enough. Thank you. These are our contributors from the last 30 days over on the website. Huge thank you to everyone who sent super hearts, Michael and Anthony, 64,000 super hearts. Love you guys so much. Carlton, I love you. I hope to never see you again. He was a troll. Please do subscribe and follow, and I will see you guys on the next juice. Take care, Rhodey. Don't drink too much coffee tonight. This has been A Moment in Time with Taylor.